so happy to welcome you to Collier's first ever client education webinar. I want to give a special welcome to those of you who are new clients to Collier, and then also those of you who have been with us for a long time, some of you on this call more than 20 years. So we decided to make this a webinar today instead of a live event because people are just so busy these days and traffic is always so bad, as you know, that we just thought this would be a much more convenient way to connect with all of you. And of course, if this does go well, and we'll do more of these in the future, I will be emailing you out a copy of this webinar so that you can view it again in the future, and those of us who could not join us will be able to view it later as well. Sorry, I just need to pause for a second. Mike and Pat Stark, I'm not sure what's going on, but for some reason you keep coming up as a presenter. So whatever you're doing, that's not working. You can give a call to the office and maybe someone can help you get on correctly. Okay, please take note of all of your questions today because at the end of the presentation, I'm going to be opening this up to a question and answer session. So I'd like to begin by talking about all the exciting changes that have been going on here at Collier. As many of you know already, on August 15th, we decided to make a broker-dealer change from VSR to KMS Financial. We made this decision because VSR was bought by a parent company called Cetera. That company then merged VSR into a Florida-based broker-dealer called Summit. So instead of just going with Summit, we chose to move to a local broker-dealer in Seattle called KMS. So far, we really appreciate the service and culture that KMS is providing us. And we believe that in turn, this is going to give us, that's going to help us give better service and better quality offerings to each of our clients. You may still be getting paperwork from VSR or from Summit. So if you have already completed your transition paperwork to come under KMS, you can disregard all of the paperwork that you're getting from VSR and Summit. If you have not yet completed your paperwork, please give us a call as soon as possible and we can help you with that. Since we made this change, there's one thing I need to let you know about. Your online access through Collier's website has also changed. So I'm going to go through that with you guys right now so that you can start logging into your accounts online. What you'll want to do, if you can see my screen here, this is our website. So in order to log into your accounts online, what you're going to do is go to Client Center and then Your Consolidated Accounts. That will bring you up a website. This is a consolidating website that goes out to all the different companies that we use to invest and brings in all of the holdings information onto this one site. So, and it's called Allbridge Solutions. So what you want to do is click Registration. You'll be asked to put in your social security number and then a client temporary password. That temporary password is CSW, Collier CSWM Online, Collier Sustainable Wealth Management Online. And then, of course, type this word that you see in the image and then click Next. What will happen then is it will be turned over to us to approve that, and then you'll be able to create a new login, new password for your login. And then in the future, you'll be able to go back to Client Center and your consolidated accounts and see all of your accounts in one place. Please take note that not everything is downloading quite yet because it just takes some time to move over. So for instance, Equus is not downloading yet. We believe everything should start coming over within, Equus will come over within a week. and then everything else will start kind of dribbling in. So eventually you should be able to see all of your account information, all of your accounts and all of your holdings in that place. Another improvement that you're going to start seeing is that you will be receiving quarterly performance reports either by email or by mail, depending on what you let us know your preference was. So that's a new thing. You'll start getting emails, quarterly performance reports that do actually come from that service Allbridge. So again, since we did this transition over, those performance reports, the performance is going to start the day it feeds into Allbridge. So it's not going to have past history in there. It's only going to be going forward. But you'll start seeing that, and I think that'll be a really great thing for everybody to be more familiar with their accounts and then also be more familiar with their holdings. Okay, so another big change that's happened here at Collier is that we have a new front office person. Her name is Donna Lynn Linkus, and she is absolutely wonderful. And after all of these years, it was finally time for Barbara to retire. As you can imagine, that was so hard to let her go after being with us for 10 years because she was such an excellent employee, as so many of you know. However, we're really lucky to have found Donna Lynn. She is super efficient and great with follow-through and follow-up, and she has 15 years experience doing exactly what Barbara did. So she's been with us for 3 months already and is pretty familiar with everything that's going on here. So if you ever need anything, you can talk to me, of course, email me or call, or you can email Donna Lynn, and her email address is just Donna Lynn, DONILYN at collierswm.com. Okay, so that's it for new business. I'm sure some of you have questions about the transition over to KMS, and some of the new people have some questions too. So please feel free to reach out. And also, if we haven't seen you in a while, we want you to reach out and let us know if anything's changed in your financial situation. But for now, that's it for new business, and I want to get to the meat of the presentation. Okay, as some of you know, over the last few years, I've been using a third-party asset management platform called Equus for a portion of my clients' portfolios. The reason I like them over so many other choices that I have, for all the choices that I have for investments, it's because it allows me to put together portfolios using some of the best money managers in the world at a comparatively low cost to the investor. And many of these individual managers have upwards of $1 million per account minimum. However, Equus allows the minimum to be much lower than that, so I can diversify across multiple money managers in one account. So if I don't like one of the money managers that are in your portfolio, I can fire that manager and add a better one. I believe this is one of the best investment solutions that's available today and way better than mutual funds. And we're going to talk about why that is in just a moment. Today I've brought together 4 guest speakers from Equus that I think are going to be really interesting for you. Our first speaker is Dr. Ken Kim. Dr. Kim is going to be talking about the problem with mutual funds. And this is going to echo why I'm currently choosing to use Equus and not mutual funds, and also why I'm not using all of the other investment solutions that are available to me right now. He's going to then also give us his thoughts on the current economy. After Dr. Kim, you're going to hear from 3 money managers that I'm currently using in the portfolios that I've created on Equus. One is a fixed income manager that I use in the conservative pool of the Equus portfolios. One is a tactical manager that I use in the moderate pool of the Equus portfolios. Then finally, you're going to hear about one of our equity managers that I use in the growth pool of the Equus portfolios. But first, you are going to hear from Dr. Ken Kim. Dr. Kim is Chief Financial Strategist of Equus Capital. He's also an internationally recognized finance scholar, professor, and consultant. He's been cited as one of the 1,000 most prolific finance scholars of the past half century. Dr. Kim has been a professor and held appointments at prestigious universities in the United States and also in China. He was a senior financial economist at the U.S. Securities and Exchange Commission and consulted for other financial agencies and institutions as well. Thank you so much for joining us, Dr. Kim. I'm going to change over the screen to you. Let's see. Okay, Dr. Kim?
Hi, Maris. Can you hear me okay?
Okay, I can hear you now. Hello.
And can you see my screen?
I cannot yet. Not sure what's going on here. For some reason, Mike and Pat Stark keeps coming up. Whoa, I'm not sure what's going on there. Shoot.
Let's say you bought a mutual fund today and there's a stock in it that was priced at $100. Next week, the stock goes down from suffered a value loss, and you have. Now, let's say the mutual fund decides to sell this stock. Now, you're thinking that you might get some of the stock for 50. But what might have happened is that the mutual fund purchased the stock for 25 a year ago. Now, this capital gains tax, which is the 100% capital gain from having bought the stock at 25 and then selling it for 50, took to pay this capital gains tax. Even though you might have bought the mutual fund when the stock was priced at 100, and you actually known as the capital gain, the embedded capital gains problem of mutual funds. This is just one example of the tax inefficiencies. First is because when you buy a mutual fund, you don't buy the direct securities. You just buy a stake of a mutual fund. And so that's what I'll say about this tax inefficiency. There's because of this indirect ownership problems. One is called the hidden costs of mutual funds. This is a cost that we're not explicitly aware of. I won't go into the details, but it's but I can say that the average cost is greater than the explicit cost of mutual funds. So, for example, you might think that the explicit cost of a mutual cost can be about 1.5%. So this hidden cost can actually more than double the cost to the investor. You would think just by random chance that half the funds out there would outperform and the other half would underperform, but underperform. And why is that? There's a variety of reasons. One of those reasons is that they're just gigantic, $200 billion, and they get another 50,000. They don't know what to do with this. They're already booked in Microsoft, and so they're going to take this 50,000 and park it in some kind of filler stock. And so that's part of the reason. Transparency. The thing about mutual funds is that only 4 times throughout the year do you know what mutual fund manager, what kinds of stocks are in that mutual fund. They're not going to tell you except for those 4 times a year. You don't even know what your life savings is invested in. And so given this non-transparency, as you can imagine, all kinds of things like window dressing, where before the quarterly reporting, stocks that haven't been doing well and buy stocks that did do well to make it look like the mutual fund is holding good stocks and not holding bad stocks. And so anyway, I basically kind of gave a very quick overview of the mutual fund flaws. I would invite you to free on mutualfundsexposed.com. You can just download a PDF version, or you can ask Mary. What I want to talk about next is what Maris uses and what we provide for Maris from Equus, which is the managers talk after me about how they manage their portfolios. So they're not mutual funds. So managed account. Pros are they don't suffer from the tax inefficiencies that mutual funds suffer from. because you have direct ownership. A nice thing about having separately managed accounts, and something that's I know very near and dear to Maris's heart and to a lot of her clients. So, for example, if you don't want to own stocks that are in the business of firearms, tobacco, and alcohol, you can't do that with a mutual fund because a mutual fund is a bundled product. You can't ask the mutual fund manager, can you exclude a managed account because you have direct ownership of those securities. You can do this. Besides for ethical reasons, there are other reasons why this can do something known as tax lot harvest, which is you can ask Maris, every year value so I can get some tax benefit. You can't do that with a mutual fund because with a mutual fund, again, it's a bundled product. And then, 24/7, you can always know what it is that you own. Now, that's not to say that one of those cons is that if you were to approach any money manager and you want to open an account with them, they're going to sometimes 10 million, maybe as little as 500,000. And so this is a problem with having diversification. If you just approach a single money manager, that means you're relying on this. Commissions can be unpredictable. But that's the Equus solution, as Maris mentioned. Clients with direct ownership of securities, we don't worry about the manager minimums because we're using technology to have access to these money managers with as little as $25,000. And the other nice thing is that with that 25, it's managed by a dozen money managers. And so you can not only get diversification across securities, but you can get diversification across money. She selects the best money manager for the international exposure. She selects the best money manager for the domestic equity. She selects the best money. She has, this nice portfolio of diversified holdings and managers. And so that's the other nice thing about the Equus solution. That's my presentation. And so I went through that kind of economy. And what I can do is, right now I can just do a quick overview of the economy, and Maris will have some questions. She's always curious about what's going on in the economy and the markets, and we've had many conversations about my economic outlook for the upcoming 12 to 18 months. Is I would say it's slightly, and so I'm thinking maybe somewhere between a 0 and a 4% gain in the overall, mostly because the Fed is talking about raising interest rates. And so we might not just get one interest rate increase this year. There's even a slightly bullish outlook. Unemployment is at 4.9%, and it's been holding steady at 4.9. Still have low interest rates. The 10-year interest rate right now is 1.7. Inflation is also low. It's 1%. And so these are all good. Low unemployment is good. Low interest rates are good. It's always a good thing because when companies can borrow at affordable rates, they can invest and grow. If low inflation also helps the economy and it helps the markets. The yield curve is also normal. What that means for an economist, that's always a good sign. But I do have some concerns. One of my concerns involves the term, but real quickly, what it really means is that a lot of institutional investors are starting investments, and they tend to do these things when they have less than a strong bullish outlook on the economy. What's happening for the last few months, and the other concern that I have is that the markets might be a little bit slightly 26. What that means is that for the S&P 500, the price to the earnings. What's a normal ratio? Well, it's hard to say what normal is, but in the past, several months, this thing has a little bit of high valuations, and with high valuations, you're always worried about overvaluations. And so, given all of this, but there might be a little bit of overvaluation, and institutional investors are starting to lock in on some long-run income. I'm thinking that for the next 12 to 18 months, we might see a sideways market. And because there might be at least one interest rate hike, I would encourage all of Maris's clients that are on this call, this webinar with Maris, to revisit, your risk tolerance, to make sure that it is where, you and Maris feel it needs to be. And I'll leave it at that, and I know Maris will have some questions for me, but I'll just stop right here with my presentation.
And your perspective, that is super helpful, as always. And then, yes, I do count on you, amongst other sources, and position my clients' portfolios properly. But, my portfolios always come down to and what is your risk tolerance? So we need to always be communicating about your risk tolerance and where you're at right now. So always do stay in touch. So Dr. Kim, while I still have you, could you I have a couple more questions, election is going to have on the stock market?
Yeah, so that's always a good question. Is them out there that the markets do well during an election year. And the reason why is logical. I mean, a lot of promises. And so that really generates enthusiasm and causes markets to go up. I'm not sure that we're going to, then the question is, what will happen if Trump wins or if Clinton wins? Trump, is a Republican candidate, and we tend to think that Republicans are the party of business, but, with Trump, given his, international economic policies for the economy, the U.S. economy itself. But then some people worry about, Clinton getting into office. Sometimes more concerned with, socioeconomic welfare, and not so much about, big business. The markets tend to do better when a Democrat is in office, and this surprises people. In fact, I actually wrote I write a column for Forbes, and so it's an interesting thing that where, if Hillary wins, of making sure that the markets are strong and stable while they're in office, it could go really either way. I think at the end of the day, Maris, it really doesn't matter. Economy actually leads to our choice of who we select as president. Who ends up being the president has little effect on the economy itself.
Research that as well. It doesn't have so much to do with who's actually sitting as the president. Just quickly, since you're an expert on on China and China's economy and what's going on there, I'd like to get a little of.
I think the Chinese economy is fine. I mean, it's we had a little bit of a scare at the beginning of the year, but China, I know why you asked this question, because China is the second largest economy in the world, and it's a major U.S. trading partner. It could bring the entire world into a recession, but China's growth would have to grow to something like less than 3% a year. China's economy is going to grow at maybe only 6%, and as you can see, that's far from the 3%. So I don't think China's middle class just keeps growing, and that's always a good thing. And just real quickly, a few other things. I mean, China's cutting down on their corruption. China's really big on urbanization. Consumption's not happening, but and investment's not happening. What China's going to do is they're just going to continue weakening their currency to to bolster their exports. So China's taking care of themselves.
Good news. Okay, well, thank you so much, Dr. Kim. If you could stick around to the end, just in case we have any questions from the audience, that would be wonderful. Some of our money managers that I use on the Equus platform, 3 to be exact. First, we'll hear from Handy of Signal Point. Jay Handy is the CEO and senior portfolio, talking about their Signal Point stable income strategy that I am currently using in the conservative pool of my Equus portfolio, but about making more money with a lot less risk. They believe that too much chaos, noise, and news has taken over the investment, has great results. They're a money management firm that seeks to provide the best investment opportunities for clients through their use of proprietary. They take advantage of market movement and the goal of improved portfolio performance, preservation of capital, and lower investor stress. Enter. And I can unmute you. Okay, I'm not seeing Jay yet. Okay, well, that's not, oh wait, nope, don't want to see the, okay, well, I'm going to try our next person. Let's see if I can get Byron Steed on here. Yes, Byron, you seem to be drinking. Huh. We're having so many problems trying to change presenters here.
Hi, Maris.
Byron, up in there. Do you know?
I think when anything goes wrong, I like to just blame GoToMeeting.
Okay, let's
I don't think it was you.
Steed is a senior portfolio strategist and co-founder with Broxton Capital Advisors. I'm currently using their primary strategy. Broxton Capital has a mission to continuously improve the value of clients' investment assets in the most tax-efficient manner. Their ability to be contrarian in nature and exercising patience. They pride themselves on the ability to understand unique situations combined with reduced risk. Patience has been their key to success. Thanks for joining us, Byron.
This is Byron Stead from Broxton Capital. I was happy that Dr. Kim was on the call. He's always insightful, and we got to meet Maris as well up in Napa earlier this year, and she's always asking the right questions, and the difficult to be sitting there asking him some very difficult questions. So she's always working for her clients. At least that's the perception and working for everyone. But we're Broxton Capital. We're just going to go over like a 5 to 7 minute overview of who we are, what our strategy is, some current market commentary, and performance. But essentially, if you remember one thing, we're trading for 30 cents. Something that's worth $100 that's trading for $30, $40. We're located in Los Angeles. Offices, because we're in Los Angeles, actors. We used to joke it used to be just B-list actors, but I think we've got a couple A-listers. These 80s television shows that are, these actors do have money. And then the focus here is investment managers are our core business. We do, and that's all we do. We don't do insurance. We don't do any of that stuff. All we do is one product, and Al and I, for the last 15, 18 years, all we want to do is try to make money for the clients all the time. Just at a glance, the primary Broxton strategy, what is it? Which would be like discounted cash flow to determine a company's net worth. The average position is going to be mid-cap, large cap, occasional small, shorter time frame than most managers, like they're holding 3 to 5 years. But we're trying to get in at the right time, at the inflection point. For example, in 2008, when the market was down 40%, we were only down 8%. Concentration for industry less than 15. And these are kind of our core principles. How have we been able to do 18 or 23% annualized? Long-term potential. There's a lot of times companies are out of favor due to negative events or perceptions. Investors can cause liquidity. An example would be to think of Michael Phelps. A couple of years ago, I think he got in trouble. He lost all his sponsorships, and so things that like Chipotle with their health sickness right now, or their food sickness. Pollo Loco had the same thing, and it took about a while to buy it with whatever, but you get the idea. I mean, SeaWorld's the same thing. Is there value there with SeaWorld, even though the perception's wrong? So those are the companies we're looking at. Is there $20 in tangible book value for a stock that's at $4? And those are kind of the core principles of what we're doing. And again, if you % discount to their 1 to 2 year values, we're trying to target 15%, avoid risk. And one of the more important things, continually work that we can provide the same criteria. A lot of outcomes are very similar. When companies got in trouble in the 2000s, that companies get them in have been repeatable. At least we've been able to identify over time. And then we sent a copy of this to Maris about the strategy. It digs into a little bit more of how we're looking at companies. But essentially, we're looking for companies with large cash flows, proven business models. And then this would be our investment process in the stage that And in addition to the screening, doing the models, building the models, looking for transparent, the conversations that we have with them gel with what our thinking is. And again, if you want to review this later, she'll have a copy for you. Yet we're only 20% invested, so we have 80% cash. I think the accounts on Equus are up, but I mean, on the actual amount invested, that means of the stocks we bought, those are up 30–40% for the year, up like 2 beeps for the day. So we weren't down, so we were pretty happy with that. Current market observations, everyone's going to have their own ideas. Some of the more refreshing things are we all have our own ideas and how through different thought process. So you'll probably hear a lot of ideas on macro or whatever is going on, but what everyone's using their own criteria for things. For the S&P were third quarter 2014, somewhere in the 120 area range for GAAP earnings, show up about 27 months. And that's not necessarily a bad thing because it opens up volatility, it creates opportunities, things that we've been waiting. The decline in earnings that we've seen, it's like if you're up in Washington and tomorrow the forecast is 20 degrees and it's snowing, well, that's good to know. So last summer we moved to more cash based on the Q's and K's that we were reading. We just saw a continually decline in earnings on a GAAP base. You kind of worked out those numbers. And then, so the GAAP earnings has fallen, buybacks have slowed to some extent. Central banks, like between the European Central Bank and the Bank of Japan, they're adding about 200. It's a guessing game. Can they continue to do this for a while? They probably can. So you don't even really want to take your thinking there because in the last 4 weeks, Japanese government bonds went from 5 beep to up to 50 beep yield, and they lost 15% in the event, in the sense that these Japanese government bondholders lost 300 years of interest on that last one investment. I mean, it's essentially like walking in front of a truck to pick up a nickel. I mean, you might be able to do it successfully 19 out of 20 times, but and so here are our returns since 2006, and what everyone likes. $1 million invested in 2006, and Broxton's worth over $5 million now. $1 million invested in the S&P is worth like 1.8 million, maybe 3.5%. We were able to avoid 2008 using a deep value strategy. I mean, we're looking for positions. It's quite natural we see drawdowns, and given the history that we've had every 4 years. And kind of in summary, I mean, you have a couple investment managers down in Los Angeles that are pretty passionate. They're not going to overlap your other managers. We usually come up with pretty unique ideas and names that we're following. And I'll get the this presentation for you. But if you have any questions, feel free to ask.
Super. Thank you so much, Byron. I really appreciate what's going on in the economy. You know, you would hear something different from somebody else, but we are using Broxton. They are actually our biggest, the biggest portion of all of our portfolios right now. Part of the portfolio. And actually the other part of the moderate or quote-unquote tax is with a manager called Shell, and they're actually about 50% in cash right now and the rest in bonds. So they're actually also pretty bearish, tending towards the more conservative. Even our aggressive portfolios. So thank you so much, Brian. Now I'm going to go ahead and try to put it back to Jay, who I introduced earlier, who is our portfolio. Okay. Let's see.
All right. Can you hear me?
Yeah. Thank you, Jay.
We've got a connection.
Yeah.
Well, thanks, Maris. Appreciate it. I'll take it from there. I have the fortunate opportunity to be the CEO of Signal Point Asset Management, and one of the longest, or if the longest, continuous money managers on that Equus platform. We've had a long relationship with Equus. We've enjoyed their platform, and to Byron's point, the continually does, I think, should be noted to your clients, Maris, because we're constantly looked at crossing the T's, and if that's not enough, we then get I call it the Shark Tank experience with you when you kind of grind us down when you should know. So let me tell you a little bit about what we do and how we do it. Unlike buy is the fixed income piece of most of the portfolios that are suggested. It's as exciting as toothpaste. No one wants to talk about it. It's not too sexy, but you need to use it in who we are. And we've done, if I can say so myself, fairly and trying to get some yield and growth out of those investments. Who we are, what we do, and how we do it. I want to make this point. I call it the big idea in '89. Even though the market has suffered two major crashes in the last 15 years, many financial advisors, this goes to a little bit about the value of what a financial advisor is and the relationship. The clients are more concerned about the amount of risk you're assuming for them. This is I've said for 29 years, I have sat across the table with clients. I know that benchmarks are what's us, but in reality, clients have their own benchmarks, and I call them the dream money for education accounts, retirements, a second home. Those are the things. Assuming all the risk of the market is not always the most clear path to those grapes. So this is what we do, and so therefore we look for financial advisors who are looking for us to, we like to think, risk out of the market, as Mars said. We have a unique proprietary algorithmic portfolios, and we have this, as was stated, systematic repeatable process, and I'll talk about that a little bit when we look at the chart, but as Byron mentioned, the markets are always moving, they're dynamic. Now, different from what Byron says, the glass is half full, and we can talk, the next slide talks a little bit about the market, and everybody's chatting about the history of this country is stunning if you stand back and think about it. We have in the world, we have more wealth, we have more than any other, greatest armed forces. The economy eclipses all other transfer power from one party to the next. We've done that through civil wars, world war, issues that have taken grips of this country, and we still do it without bloodshed, and that's powerfully. Some people will say this is a challenging election. I will not discredit that, but we are able to go through these transitions. And with that said, in Dr. Ken Kim, 18 of the 22 years, it's 82% of the time, they provided positive performance. When a Democrat gives power to a Republican, it's up 13.2. You know what? My take has been that once someone's elected, whoever it is, they all have been taught the market is something that does not like uncertainty, and now it's certain. I'll go forward. So, and there's arguments both sides worthy of noting. So this is the portfolio that we use. Stories you just heard, say with Byron. We are the ballast or the balance in a balanced portfolio. This is what we're world. I'm not going to discount that. Why? Because it's the lowest interest rate environment the country has known since the dawn of time. Low. So we have a unique way of managing money. If you can envision this, about a 9 by quality, medium quality, and low quality, and then we have short-term, medium-term, and long-term. We have we have as a hedge a pool of cash. Now, what takes place is, as you might imagine, of up and down due to interest rate movements. Of course, longer-term bonds react differently, as do some quality issues. What takes place is, as we'll assume the value is right, trim off a portion when we hit our sell price and put that in our little dry powder pile, which is that slug of cash. That's about 20 to 23%. We've been holding that at how fast? I don't know, but they're not going to jump by 10%. But they're going to probably trend up. That's okay. Because what happens when they trend up means, yes, they'll begin to trim, but we're going to cushion that because we're not fully invested, and we're able to put higher yield. So it has an effect, and this is important to understand, sort of smooth out the path in which your holdings in this allocation will take, versus being a pork in the sea of just owning a long-term, and you're just left holding an investment that's deteriorating. So we have this this has a buy and sell on each holding, and this tends to work out very nicely through a full market cycle, as you can see up in the two upper charts there. So that is my story. I can need to look at, but there they are, and we can go back to there. So, Maris, do you have any questions, thoughts?
Oh, thank you so much, Jay. That was here, and so we're really happy to have you in our the conservative portion of our Equus portfolios. So if you want to stick around, thank you so much. And I'd like to introduce our next speaker, Pam Neville from Equus. Pam was a financial advisor for Fisher Investments as a senior vice president of the Rocky Mountain region. She's been with Equus for almost 4 years, and as a vice president, business consultant for Rocky Mountain region and the Pacific Northwest. Looks like you're on the Rocky Mountain region twice there. Which investment management, one of our strategic managers on our portfolio. Just heard from two tact metrical things to the market, so they have different philosophies that you just learned about. But our growth pool, but just looking for the best money managers for each one of those sections. So she'll be talking about Martin Investment Management and they portfolios. So let me move that over to you, Pam. Let's see if I can get that to happen. Is that working, Pam? Let's see if I need to unmute you.
Yeah. Can you hear me okay?
I can, thank you.
Good. And can you see my screen?
I can, thanks.
One, allowing me to speak. Thanks for taking your time this morning. I have worked with Maris since my first day at Equus. She does her due diligence. She's one of the advisors that always asks the tough questions, always in the interest of clients. So as Maris already mentioned in regard to Martin, Martin is a strategic known as buy and hold managers. Another thing that you might hear them referred to as a style box manager, where it's large cap, mid cap, small cap, value and growth, or maybe a blend of both value and growth. Well, Martin's always going to be large cap growth, and they're always going to stay invested in large cap stocks. It's going to go to cash, but that does not mean they're passive. They are actively managing the stocks within the portfolio, stay exposed to their equity strategy at all times. So one of the defining things about Martin is they've been around. They're one of the longest term managers on the Equus platform. We've had a great relationship with them. They also manage another Global Echo, and we'll talk about that in a minute as well. That's what you see right here. So all of their portfolios, they utilize what they, rather than owning some portfolios, and certainly mutual funds will own hundreds of stocks, 70, 80 stocks. Martin owns within the range of 25 to 30 stocks that are their best. Validates that that's a big enough number to get a true representation of their equity style. They tend to buy. I mean, they're a qualitative manager, meaning the research that they do, and they're doing old-fashioned qualitative stuff that I'll talk about here in a minute. but they are really using on the, they start with a universe of somewhere around 2,000 stocks, and they begin to screen them for returns on invested cash flow and their capital structure, meaning they don't want them to have too much debt. Stocks that are selected for the portfolio that are understandable. They want distinct strategies. They want products and services within their categories. They tend to be, I mean, they are a long-term investment manager. They Buffett-like strategy where they're buying companies that are really businesses that they would want to actually personally own in order to, over a long period of time, be the beneficiary or the recipient of that company's growth. So this chart is a little busy, but their benchmark is the S&P 500. Just a minute about, we'll go over their top 10 holdings briefly. This one is a little bit outdated. I haven't updated. One of the things that's kind of important to understand about this portfolio, especially, well, particularly in taxable accounts, they will sell a stock for a couple of reasons. And this is, believe it or not, as important as the discipline of knowing how and when to buy a stock. So on the sell side, they will sell as fundamentals decline, low earnings and sales. They will sell if their valuation becomes too high, meaning if the stock is just simply, maybe there's not enough upside to warrant, holding the stock. They'll sell if the position becomes too large, going up, becoming higher price and representing a bigger portion of the portfolio that they want it to. And then last, want to own the 25 to 30 best stocks that they can identify. On this top are actually in the portfolio right now a couple that I think are notable that I see a little Gamble, and they own Johnson & Johnson. They also own Berkshire Hathaway, which is Warren Buffett's company, of course. Consumer staple stocks. What that means is that consumer staples tends to be thought of as a defensive goods and services that investors continue to buy even in a recessionary environment. Their products are always in demand. Those are things like food, beverages, tobacco, household items. So Johnson & Johnson and Procter & Gamble are two very good examples. Maybe does indicate that they and I don't want to speak for them, I don't know this, but it's a pretty significant weighting. I think there is a possibility of, economy slowing. And that's as opposed to the other side of that, which is consumer non-essential. There are things like cars and appliances, entertainment and leisure, things that people can actually, they feel like they have enough spare income to do it. So in the sector breakdown of what they own, healthcare, they own Gilead Sciences, and they also own Celgene. Those are two biotech/healthcare companies. Accenture, this one right here, is no longer in the top 10, but they have a pretty big weighting in both healthcare. I'm not going to take too much time to go over this one. This is actually a really, I guess, that might appeal to advisors like Maris in order to give her confidence in using Martin. They make available to advisors and then to clients. Martin is one of the top managers in terms of seats consistently over a long period of time. What you see here is this PSN, it's called PSN Top Gun, institutional piece that's generated quarterly. The reason it matters is that if you're an institute plans, the Harvard Endowment, the Yale Endowment, they gather their data from institutional database, of which Martin is one. So this is just basically a recognition that says that story over and over and over again. So I think with that, I am going to close and see if you guys, yeah, I'm going to stop at, I'm sorry, I keep hearing an echo. I'm going to talk just for a minute about Martin Global said in regard to Martin Large Cap Growth. Apply to Martin Global Echo. It's a best ideas portfolio. Again, they focus on They want to make sure they're looking for the best opportunities, the best values that they can find. But the other thing that they globally, whereas the other portfolio is largely U.S., companies globally, that strategy is basically one that's looking for companies that they believe have clearly service offerings. They, again, base their stock selection on all the fundamentals that I mentioned, but also in what they deem to be the best environmental practices. So it's a kind of a, regardless of that, it's one of the best international managers that we have. The other thing that's no national developed. So that would be things like Europe, Australia, the Far East. They're not buying emerging market companies. Very competitive, and again, won a number of awards and accolades for this portfolio as well. So I think I'm finished.
Thank you so much for speaking with us today. Okay, I would now like to open it up to, I'm going to go, let's see. If you do have any questions, go ahead. I can write it out. The chat box should be on your, in the GoToMeeting section. Okay, not seeing for you to reach out to me. As you know, we're here all regular business hours. If you need to, if you weren't here for the beginning of, since I did get kicked off somehow in the beginning of the presentation, but my portion was at the very beginning, to hear from them to make sure that your risk tolerance is what I think it is, so that you're properly invested, which is always important. So it's always important for us to keep on the same page with your financial situation. As you know, I do full finance. We are always taking your whole financial picture into consideration. Oh, it looks national debt. This is from Carl Collier. If that name is familiar to anyone, that is actually my father, who is also an investor here. Deflation and negative returns. I assume you mean negative returns in the stock market. If you don't mean that, Ken Kim, and see if he has a good response to this. Oh, here's another one too. Okay, with national debt increase and negative returns. Dr. Kim, what would you say to that?
It's possible, and so that all the time. And I always, like to use an analogy that a lot of times, we own homes. The value of a house is like 3 times the, or 4 times the size of our annual income. Larger than your annual income. Are you nervous about it? And most people will say no. And so that's kind of the analogy that I like to use. I mean, we do have a
It's true that we have an increasing debt, but has it not, as a proportion of our GDP, has that?
The proportion of the debt to our GDP is actually increasing. So if this is your dad, he's right that it is kind of a concern. And so, I mean, with what are we gonna see? Well, the Fed, especially like the members of the Fed that are sort of dove-ish rates, and Janet Yellen, the chair, she's one that favors low interest rates, and she would probably, if we get into an area of deflation, what does that mean? That we're going to actually have interest rates that get into the negative territory? I mean, we've seen that have negative interest rates. I personally, feel like if we do get into a situation of deflation, and we do get that's going to be not like a devastating thing. I mean, a lot of economies that currently have negative interest rates, their economies have actually, but it's benefited from it. And so, I mean, so it's possible, and that just means that the Fed is going to have to, as long as the Fed does something, to react to it in a proper way.
Okay, excellent. I have another client. So David's looking at retiring in the next 8 to 10 years, and so he's asking, what should one look at for this upcoming period? Be retiring in the next 8 to 10 years. Should he be moving more conservative for this upcoming period? David?
Well, if I still have the floor, Maris, I mean, I would say that the money managers that you have on here right now, you've got Broxton, that is tactical, and they've been historically very good at for markets that where they feel like, you know, where a pullback is possible. You've got Signal Point that's Jay Handy is much about beating benchmarks, but is, you know, but focuses more on absolute returns, and you know, and so that's, you know, a good place to, you know, to put money. You know, so they're always going for growth, but, you know, they always try to, you know, keep an eye on risk. And so the three guys that you have on here right now, I should not be giving investment advice to someone
Right, yeah. So I'll actually,
that I have not
yeah, let me,
yeah, that I have not spent, you know, at least an hour with, because financial picture, and, you know, what the kinds of things that he needs money for, and, you know, how much savings he has, and those things, you know, and so, you know, I'll just leave it at that.
yeah, well, so one thing I'd like to say about that is timing the market is almost, it really makes people money is not timing the market, but time in the market. And, you know, over 8 to 10 years, especially back. But when people get out of the market, it's always, you know, at the bottom. It's usually at the bottom, and then they wait to get back. Exactly when the bottom of a market is almost impossible. But the people who stay in for the long term do always do the best. I mean, if you have enough time. And then also, when you're in retirement, you do still need equities. There's also been some great research showing that up in fixed income, you actually maybe want to start adding, maybe, you know, maybe if you retire with a 60-40 or 50 to keep up with inflation. So even if you have, you know, 8 to 10, 3 to 4 years, and that's the only way you're going to stay ahead of inflation, you know, that could happen down the road. You know, of course, of the portfolio is structured so that we are more conservative than normal, but we're not trying to completely to do, and, you know, more often people get it wrong than get it right. So hopefully that answered your question, David, but I can always get, if he's not in China or working, I can usually get Dr. Kim on the phone if you want some more information from him as well. Okay, has probably tired of this already. So lovely. Thank you so much for everyone joining us today. We really appreciate your shifts that are happening in Collier and all the paperwork that's happening. If you have any question with that, give me a call. Otherwise, thanks all.